So I think that's the first time I got a feeling that it will go bad. Fixed income is an OTC market, which means that you have to speak over the phone to do a deal. See, when you are speaking to someone, it's very easy for you to make out this is not working out. 9:15 the equity market opens. There are no trades on the equity, no trades, no buy order, no sell order for 15-20 minutes. It was like blank.
Welcome to Money Masters, the long conversations with people who have spent decades in the market with real life consequences. Today's guest is Santosh Kamath, President and CIO at Franklin Templeton Alternative Investments. Over 3 decades, he has worked across equities and fixed income, and he was at the helm during one of the most difficult periods of the Indian debt market. In recent years, the 2020 dislocation. This is not about predictions. It is about process, temperament, learning, and his genesis as an investor in the Indian market. So welcome, Santosh.
Thank you, Dhirendra.
I want to start with every real investing story before markets, which is growing up. Was money discussed openly at home?
Just to give you background, so I was born and brought up in a place called Bhilai.
Bhilai.
Which was
the steel plant.
Steel plant.
Okay.
And frankly, if you ask me what I am today, a huge part of this because of what Bhilai steel plant did for us. So it was a steel plant, but the good part was
steel mill.
Steel mills, and it was way back in 1960s when it started. Whenever you work in a township or you stay in a township like BHL or Bhilai, the good part is that you get a very cosmo culture, which was unlike at those point of time. So you had all kind of people in the society. So there was I grew up. My dad used to work in the steel plant, and frankly, all your money matters used to come only to say where not to spend, right? Because you didn't have enough money to take care of all your needs. So in my mind, at that point of time, the concept of money was you have to be very careful with money. It's very hard to come by, and it's come in a very hard way, and therefore be very careful with money. I think
there was silent anxiety about it.
Yeah, so
it's not enough.
It's not enough, and you have to be very careful. Very careful doesn't mean don't spend it. And till now, if you ask me, that stayed in my mind that you have to be careful with money.
Those values are deeply embedded.
Absolutely. So you won't believe. So when I pass in my office and I see a light on in a cabin and nobody's there, you believe me, I'll go and put it off. It may be a few paise, but it's stuck in my mind that you need to be careful with the money. Don't splurge on unnecessary things.
So, what did security mean in your house? The savings, your job stability, education. So it was all guided by that.
Yeah, the first thing was that you have to make sure that you don't splurge. Splurge means you don't buy things that are not necessary. At the same point of time, I should give the credit to my parents. So when I was in Bhilai, there are 2 types of schools. One was the local school where there was no fees. And there was a CBSE school where you need to pay fees. And as I said, money was hard to come by. But my parents decided that no, for knowledge or for education, you make sure that you spend. So I think that what CBSE did to me, and 11, 12 years of CBSE, I think it was a fantastic foundation I could think of.
So those early days about ideas about risk often show up later in your investing instincts. Who made you more cautious, or who made you more courageous?
I think the fear of that if you don't study hard, if you don't get a good job, if you don't manage money carefully, you will be stuck in a bad life for long. I think that fear was the big motivator.
Okay.
Once your basic needs are taken care of, you have a financial security, then you think of going for upside. The first few years of growing up was to make sure that we need to have a good life. For that, you need to study hard and work hard and get a good job. I think protecting the downside at that point of time significantly weighed more than going for the upside.
You did your engineering. Is that engineering mindset still, shows up in your decisions?
Yeah, I think it's both positive and negative. So typically at that point of time, you only 2 options. Either you study engineering or you study medical. And you won't believe this, Bhilai was known for sending students to IITs. Any IIT you look at, there will be students from Bhilai. I think there was something in Bhilai schools where IIT was kind of the focus area.
Also because of the parents, they were mostly engineers.
Engineers and education was one of the key things to happen. Right? We used to always say jokingly that you take care of Saraswati and Lakshmi will come. So don't think about Lakshmi, keep thinking about knowledge and the money will come and the job will come. So when you do engineering, it's all about numbers, more about numbers. So once you become an engineer, you are so much of logical thinking that you want everything in black and white. So if you have a maths problem, either the answer is wrong or right. If the answer is 6, if you get it 7, it's wrong. If you get answer is 5, if you get 5, it's wrong. So that is essential part of investment that you do. You have to be strong with numbers. But equally important, the qualitative aspects are also equally important. So what I have seen in life, anyone who is very good in numbers typically is weak on the creative side. Somebody who is very strong on creative will be weak on numbers. As a fund management, according to me, 50% of the time you have to be with numbers and 50% has to be without numbers.
Perspective.
The perception, the story, what's going ahead. Now you can't be good in both, but at least if you have optimum in both, I think that helps a lot. So engineering can be very helpful on the first part. It can actually be very harmful for the second part. So if you can't do it yourself, you make sure that if you're good in numbers, you should have someone in the team who brings the complementary skills. So both these skills are essential. So numbers obviously help me a lot. Fixed income significantly is more numbers oriented than maybe.
So engineering makes you, systems thinking or stress testing and validating models.
Absolutely.
And then you choose investing.
Yeah.
How did this, this change come about? When you thought that you can well be an investor, or you will be choosing a career which is around investing?
Accidental fund manager, if you want to call it. So I did my engineering and then I did my MBA and went to XLRI.
Okay.
And luckily my first job was the once in a lifetime opportunity. My first job was at SBI Mutual Fund.
Okay.
And guess what? Way back in 1993, it was in equity research. Equity research was just starting up. So was lucky
that is post Great Indian Scam.
Absolutely. Hasan Mehta came up and went. So luckily you just...
So you worked with Prashant Jain there?
Yeah.
Okay.
So if you look at most of the fund managers of my generation, either they had a background with UTI or with SBI Mutual Fund. Because these are the two companies which used to hire MBAs for fund management. So those early years of 2.5 years of doing equity research in SBI Mutual Fund, it was so much fun and so much of learning. I must have visited maybe 100 companies, site visits, during the 2.5 years of SBI Mutual Fund.
Equity research.
Of equity research.
Not fixed income, not looking at credit.
No, it was pure equity research, right? And imagine, I used to go from SBI Mutual Fund to visit a company. Mutual fund was not known in 1993. So the company used to think somebody has come from State Bank of India, and SBI was the largest bank in the country. So the treatment,
they'll treat you like a fund manager, branch manager.
As a branch manager, right? It was a
you can lend them money, you can give them a cash credit or...
That's what they thought, and therefore that learning was fantastic for the 2.5, 3 years of meeting so many companies. So I jokingly say, I don't think you can find many fixed income fund managers who have visited a steel plant and a textile mill and a shrimp factory. So I think all that was a fantastic experience for me at those times.
So tell me some stories around that time. What was your first experience? You visited a company.
Right.
And what will you ask? Will you be looking at that, are these numbers real, what they show in the annual report? What was your attitude to evaluating these companies?
Yeah. So that point of time, it was early stage of the career. You went to understand how does it work. So if you go to a refinery, you want to understand how does this refinery work. Numbers was like way behind, kind of thinking process. But there was very good incident stories. So I remember at that point of time, SBI had one NPA in the books. Okay. I can't tell you the name of the company. So
now it is 30-year-old.
No, but the group is still alive, right? So today. So my boss told me that why don't you go? There's interest pending from them and they are not paying. Why don't you go and meet them and check with them?
Okay.
I went there. It was the most spanky office in Mumbai. Okay. I was so zapped that this is a fantastic office, the most spanky office in Mumbai. And guess what? He's defaulted on SBI, SBI Mutual Fund. So I went back to my boss and said, I'm not able to connect this dot, right? That time he told me, there's always a difference between intention to pay and the ability to pay. You may have the ability to pay, but if you don't have intention to pay, you will not pay.
You won't get the money.
So that, I thought people don't pay because they don't have the ability to pay. But if you go to a spanky office and say...
That rule applies only to poor people.
Yep. Yep.
In those early days at SBI after your MBA from XLRI, when it really got formalized in your mind that this is what you are cut out for?
So those 2-3 years I knew it was fantastic fun.
That you belong to that profession.
Yeah, because the good part about what every day was a new day there. So I used to jokingly say that if you get a job, every day you have to do the same thing. And you get to a job where every day some news is coming about a company, you have to analyze that company, the share price is going up, share price is going down. So it was excitement on a daily basis. I thought, wow, this is the place I need to be in. But guess what? 2.5 years I was enjoying my job. It was fantastic. A large Hong Kong-based fund came up in India looking for a fixed income fund manager.
Okay.
And I was so thrilled with equity. I said, wow, I'm doing a fantastic job. And I got a call. I went there. And these guys offered me some 8-9 times what I was making in SBI mutual fund. So you can imagine there's excitement, you like the job, and somebody comes and offers you
lot of money too.
Lot of money. So I went to my boss. So whenever I have doubt, I know whom to go. So I went to the boss and said, I like my job fantastically.
Who was your boss in SBI then? Padma Kumar or?
No, there was a guy named Rajesh Elavadi.
Okay.
He was the head of research. Padma Kumar was
head of research.
Head of research.
He was one of the fund managers.
Padma Kumar was one of the fund managers. So Rajesh Elavadi told me, it was from State Bank of India.
Because I remember those days, I used to interact with the SBI people, MS Verma, Kakodkar, and
Absolutely.
those.
Correct.
Because most SBI CEOs actually went on to become the SBI chairman.
Right. Yeah. So we had all the senior people from State Bank of India and all the juniors coming from the MBA schools. So that was the. So I went and told him. He told me, Santosh, at that kind of money, forget about fixed income. They ask you to do anything. Just go and do it because this 8-9 money is significantly. And so I reluctantly went to fixed income.
He encouraged you that for this money you can go.
You can do whatever, right? And went there. But the equity at the back of the mind always stayed. And obviously I did fixed income. But again, as irony has it,
So that was a fixed income role.
That was a fixed income fund manager. From equity research to fixed income fund manager. But as they say, if it's too good to be true, there's some catch somewhere. It was too good to be true to get 8 times the salary. Asian crisis happened, and the company said, "Thank you very much. We don't need you." So today also, it's bad if you lose your job. You can imagine 1997, 98. If you lose your job, the first thing in people's mind was, "Isne kuch garbad kiya hoga." So I was just married, I had a small kid, I didn't have a house in Mumbai. At that point, the only objective was to get a job somewhere. Therefore, whenever when job cut happens and all that, now I actually relate to what happened to me.
You can empathize with the pain people
right?
might be
Unless
going
you
through.
go through it then yourself. It's very easy to say, "Oh, that person will get a job somewhere else," but it can be difficult. But guess what?
Now you can say that person will get a job somewhere else. You got one.
So luckily for me, I got a job in CRISIL.
Okay.
Now let's look at how the career is unfolding. Right? You had equity research, you had fixed income, and a job got a CRISIL, which was a rating agency. So over a period of time, incidentally, therefore I say it's accidental fund manager, you had equity exposure, you had debt exposure, and then you had a rating exposure. Then guess what? I came back to the mutual fund industry. I joined Zurich Mutual Fund, which was looking for a fixed income. So back to the industry. But again, Zurich was doing very well. Prashant was looking at equity, I was looking at debt, it was doing very well.
So suddenly both of you somehow moved around from SBI to
Zurich
meet at
Mutual
Zurich.
Fund.
Okay.
And so I think the difficult part of a parent of a foreign company is that if something happens to the global officer, it can impact the local officers. So then Zurich said that we want to exit India. Now imagine Zurich was doing extremely well. So I thought Jardine was not doing well. It got sold. Zurich was doing extremely well, and it was bought by HDFC Mutual Fund. But I somehow got convinced myself to join ING Mutual Fund. That was one mistake. I shouldn't call it a mistake. The impact of that, because I thought I was a smart guy, I was a go-getter. I'll go to a small company and we'll make a big difference. It was so difficult. Now I realize the importance of the brand you work in. Right? It was a decent brand in Europe, but India nobody knew ING too much. It was so difficult to wrap up the AUM there. But again, blessing in disguise, I used to spend a significant amount of time meeting distributors and meeting customers because I knew if we don't get AUM, I will lose my job again. Okay. So when I look back, equity, fixed income, ratings, ING is for quasi-sales. And 2006, I joined Templeton with all this 4-5 of expertise.
This much of journey, long journey.
I joined Templeton.
After 14 years, in these 14 years, what do you think, who was the most important mentor for you? What changed? Any of this, CRISIL, equity at State SBI and this and
I think the biggest influence was Mr. Ravi Mohan, who used to be the CEO of CRISIL. A fantastic gentleman. And the way he used to think totally out of the box. He was a person who says, give me ideas which are, you won't believe this. So he told me at that point of time, you're coming from a mutual fund background. I want to develop an app which will do a real-time NAV. Why should we have a NAV at the end of the day? You know the portfolio. Assume that the portfolio has not changed. The investor should know. And then, because at that point of time, there was a company called IISL, which was provided in the index, and CRISIL was involved in that company. So we have IISL, which is the index provider. It can calculate the price on every second basis. You should know the NAV at 12 o'clock. What's the NAV of a fund?
He being the mentor, how did he change your thinking?
I think out of the box thinking, he used to always challenge the norm. He used to say, think out of the box. If you want to make CRISIL 10 times turnover in the next 10 years, what should we do? And guess what? He used to ask the most junior most person to the most senior most person, I think that stayed with me. That you can't be at a stage where I say, I know everything. You should have a team which keeps giving you views and kind of share views and opinions. The junior most or the senior most should not matter. If you encourage that, I think ideas keeps coming up. I think that was a key learning, that if you become a leader someday, encourage your team to give you as many different ideas. I think that will help in the long run.
Now I want to move from who shaped you to how you operate. So tell me about the early mistake that stung. Something which really was painful.
Yeah, I think it was when I was working in CRISIL. It was those 1999-2000 IT boom, right? And I invested almost all my savings in that personal savings into all these IT funds, right? I remember, if I'm not wrong, Infosys at that point of time went up some 15 times in 1 year. So I think if you look at the adjusted price, I think it went from 10 to maybe 150. Can you imagine there is a 15-time price movement? I thought that all the other guys were doing some menial work. They don't understand this market. This is the best thing to happen. So I keep jokingly saying that equity is the only field where the success can tell you that you are very talented while you may not be. So for example, I say that if you don't know how to sing, if you open your mouth for one line, I can tell you don't know how to sing. If you don't know how to paint, one brush paint, I can tell you that you don't know how to paint. But equity market are such that because these returns are so good, even if you don't know anything about the markets, you tend to believe that I know. So I thought I was the best, smartest guy in the town. I made so much money. But guess what? After that 2001 happened, I think NAVs fell by some 60-70% of the IT funds. So I think the journey
all technology funds went down to by 70-80%.
Absolutely right. So I think that stayed with me. So anything which is too good to be true today, the first thing in my mind is, oh, by the way, this happened, 20 years back in 2000. And for example, if a commodity prices goes up very sharply, from 3 times in 1 year, first thing in the back of the mind is, guess what? This has happened 20 years back. I've seen that actually.
You figured your blind spot that these things happen. And over 30 years, what changes is not just skill, it's temperament. So what changed most in you?
I think before that, you asked me what are the kind of mistakes. I can tell you one of the good things which has happened over the last 20-25 years. And again, when opportunities come by, if you are just pure common sense, I'll tell you a story about...
it's the most uncommon thing.
Absolutely. Very, very uncommon. So, you remember Morgan Stanley Growth Fund? I think it was launched in 1994. It was a 15-year closed-ended fund. If I'm not mistaken, they collected 1,000 crores. I was just compounding. If the 1,000 crores at 13% CAGR today is worth 50,000 crores. So something is equivalent to a fund launching today, 15 years of closed-ended fund, and garnering 50,000 crores. Can you imagine the impact? At that point of time, obviously people thought it's a NAV will shoot up as soon as it got listed and all that. And it was a normal fund. It was an NAV fund, and therefore the NAV didn't shoot up, and therefore people start selling. That fund, till it matured in 15 years, it used to quote at a 30-40% discount to the NAV. At that point of time, it was I was in ING at that point of time, 3-4 years or 2 years left for maturity of the fund. It is available at 35-40% discount to NAV. So if NAV is 100, you could buy this fund at 60.
All the closed-end funds actually used to trade at discount.
That's why I did the reverse calculation. But many of the closed-end funds were not listed in the exchange. These are listed in the exchange. So I calculated that if you can make 40 on 60, the discount of 40 means it's available at 60, you can make 60-70% return on this fund. All my savings, every day, whenever I used to get money, I used to go and buy Morgan Stanley closed-ended fund at a 40% discount in NAV. Guess what? 2 years happened. The market moved up a bit, and this 60 became 100 because closed-ended fund, when mature, it gives you the NAV back. I think then I realized that there are so many stalwarts in the industry, knows the market so well. It's like today, if you say Franklin Templeton blue chip fund is available at a 40% discount to the NAV, it's unthinkable, right?
Value research's existence is actually rooted in that discount to NAV of the closed-end fund.
Wow, okay.
That is when in 1993, that is how value research got created, by creating a scorecard of mutual fund NAVs and the prices alongside.
Right.
So we had about 13 mutual funds which were listed.
Right.
Master Share, Can Growth, Magnum Multiplier Scheme 19, Magnum Multiplier Scheme 93, alongside Morgan Stanley was another fund called Kothari Blue Chip.
Okay. So it was closed at that point of time.
That was a 3-year closed-end fund, where the NAV came from 10 rupees to 30 rupees and then slipped to 20 rupees or some 13 rupees at its redemption. Something like 10 to 20 and then 13. So I know that, I can really relate to
Yeah.
all those things, and it lasted for a long time.
Yeah.
4
So that
5
was
years
one
later.
for me. Second for me was in 2012, Franklin Templeton launched an US equity fund. And it was a fund which was feeder fund. We used to take the money and invest in US way back in Feb 2012.
It was available for domestic investors?
All domestic investors, right? And I thought it was a fantastic fund because as an Indian,
No, institutional investors, because it was not a retail.
it was a retail fund. Nobody knows about it too much. Feb 2012, we launched this fund. It's a retail investor fund. You could have invested $5,000 to 1,000 crores because it was not under that Alara scheme. You could have invested any amount.
And in rupee.
In rupees.
Okay.
Right? And can you imagine at that point of time, I think if I'm not mistaken, Apple as a stock was quoted at a P of 10, firstly. Secondly, it was a dollar asset. So I used to go and say, if you want to send your kids for education outside, you need to have dollar as the currency. And as an Indian, you don't have a dollar currency. What happens if rupee depreciates sharply? You need to have a dollar asset.
Which year was this?
This is 2012.
This is 2012.
So I said, if you need a dollar asset, a small investor cannot get a dollar asset, right? The only way to get dollar asset is come through this fund. You're getting a dollar fund. Guess what? Apple NAV P is at 10. You're getting a fantastic price. You're getting a dollar asset. But unfortunately, I don't know why this fund should have been a $10 billion fund for us.
Yeah,
frankly.
it never took off.
So a significant part of my saving was in that fund. I've made a good amount of money there because
When it got wound up.
then it's still there.
It is still there?
It's still there. But now there are limits of SEBI and that you cannot, kind of do more than X amount and all that. So the good part was rupee depreciated. Personally, for me, it was good. And the NAV went up because Apple.
These are your big wins,
These are the
personally.
two big wins, I think.
What changed most, over these 30 years is so much of temperamental change, or, your experiences influences you.
Yeah.
What changed most in you, Is it confidence, humility, or you are now, you are far more courageous now?
I think anyone who spent 30 years in the market, I think will learn humility by itself. Because the market will
the
teach you
straps
for
of the market.
sure. Absolutely. The market will make sure the ups and downs. You will definitely come to know that nothing is for permanent. If the times are good, a time will come when it will be difficult. So I think humility comes up for sure if you spend so many years. And
It humbles you anyway.
And secondly, I think whenever things are doing very good for you, the back of the mind, this is not going to last. At the same point of time, when things are not going too good, you know that you've seen enough cycles. A time will come when things will change. I think both sides, and only if you spend your time, I think in the market, only then you can learn this. If I tell a new kid today, they'll say, no, they can't appreciate it so much unless you go through it yourself.
Which was the toughest period when holding your nerve, when it was nearly impossible to do it?
You can guess it, right?
Okay, again, I have to get to
April 23rd, 2020, right?
What did you do to actually stay calm? Your routine, or data, talking to all kind of apprehensive people, skeptics?
I think it was obviously a big jolt at that point. Personally, when the stress build up, obviously you don't know what to do. So
Were you in any kind of dilemma? Should I do this? Should I do that?
No, we are very clear as a company. So the good part about Franklin Templeton is that whenever decision is taken, it's a decision what we take for the best interest of the unit holders. If you're very clear that what you're done is good for the unit holders, I think that stays with you because you know there's no other agenda for this. But that point of time, I think what helped me a lot, till that time, I was that, people keep saying, typically you have three characteristics in every human. Sattvic, Rajasic and Tamasic, right? Sattvic is supposed to be more silent, knowledge, calm. Rajasic is, you want to fight it out, you have to ambition and action and all that. And Tamasic is the opposite of that. I think till that time, I was significantly more Rajasic at that point. You have to go getter, you have to build your AUM, you need to be the good fund manager and all that stuff.
And deliver returns. And
absolutely, right? And that
is
essential.
Brash about it.
Yeah, and some part of that is essential. If you need to grow in life, you need to have some amount of Rajasic qualities in you. But that point of time is a time when I got introduced to a bit about spirituality.
Okay.
I first started following Vedanta, and that was significantly more sattvic. And believe me, then at that point of time, you need something to hold on. And I think that gave me a significant amount of stability at that point of time. And then I stayed with it for, now I follow spirituality quite regularly. Other thing was...
Did it change your routine? Do you do things differently every day?
So, what I say that for any human to grow, I keep jokingly saying that, which side the trees grow. If I ask you which side the tree grows, you will say it goes up.
Yeah,
it goes up, right?
With the roots as well.
Yeah, but unless it grows down, it cannot grow up. And going down, it means that you have to, and that is not an easy job for a tree to do. You have dark and damp, and you have to keep putting your roots down. So I think for any human to do well, according to me, over a period of time, you need to have a couple of things. You need to be physically fit, you need to be mentally fit, and you need to have some spiritual background. So I tried doing all the three over the last 7-8 years. Physically, I remember when I used to go to gym, all the stress used to vanish because you are concentrated on your weights and you're sweating and all that stuff. So I think physical fitness at that point of came up to me. Mental fitness. I did my CFA a couple of years back. You won't believe it. At the age of 55, I did my CFA. And a bit of spirituality. I think these three, helped me a lot.
Okay. That was a change. Tell me a story about, where you admit you did a mistake and then you admitted it quickly. In these 30 years, you will have many such examples.
Yeah. I think Franklin Templeton, that way, is a fantastic company.
Not Franklin Templeton, all your investment career.
Yeah,
you did something and then you realized, oh, this was not the deal, or this I never expected. You came across a surprise.
I think when I joined ING, as I said, I thought I can make a big difference. I was a smart dude and I can...
Global multinational.
Absolutely. But when I went there, I realized it's so difficult to start something from
ground
up. If I had joined HDFC at that point of time, it was a fantastic brand, and it was easy to get a job out of there. I think I realized, my respect for entrepreneurs went up significantly more when they start something from the scratch and they build it. I think it's not everyone's cup of tea, the kind of patience, the kind of work you require. So I think that was the time I thought, oh my God, I did a mistake. I should have done an easy job of...
because you were it was a fairly early stage for ING investment management, which was, and they had, it existed for a long time. Then they started Optimics and Savings Trust and then ING Vaishya, and then they had insurance companies, and then they eventually wound up with most of their businesses here. What do you think it was a real thing? Because they're actually delving deeper into the history of growth, failure, and disappearance of many investment management companies. What was the missing thing? What was the most missing thing, absent thing in which led to the disappearance?
I think it's very difficult to pinpoint on one thing, but I can tell you that to be small and compete with big boys, I think it requires huge amount of patience and teamwork and team and all that. If you're small, you don't get a good team because you can't pay so much. If you don't get a good team, then obviously anyway you are on the back foot. Size is the issue. You might be the best fund, but some large investor will say, how do you allocate money to you? You're too small. I think it's a difficult
vicious
negative circle, basically. Right? So, at that point of time, I actually thought I would have been much better off if actually I would have taken a position in HDFC mutual fund, like that.
Good versus great, what is, the temperament, process, learning speed, all these things. If you have to pick just one, what is it?
I think a flexible mind. Because there's so much
temperament.
Yeah, temperament, and there's so many things changing. If you start believing that you know everything, and I will have a closed mind. So I keep, the irony of being a good fund manager is that you should be able to carry strong views, because if your views are not very strong, you will move every day here and there. At the same point of time, you should be opposite characteristic of being open-minded. Now this combination is very difficult to combine. People who have strong views, typically they are not open-minded. If you're open-minded, typically your views are all over the place. If you can develop a characteristic that you have a strong view, at the same point of time, you're open to ideas saying that by any chance, if I get convinced,
will be wrong.
I will be wrong, then I should be able to change my views, basically. I think that is the key, according to me.
What is your definition of, risk? What do you think is risk? Is the center of everything?
I think the risk, over a period of time, the way you think about
how
risk
do you
changes,
define
right?
it? Equity risk, fixed income, and all. But I'm generally saying that, how have you gone about this? Have you really evolved a definition of risk?
Yeah, so for me, as I said, at the very beginning, the risk was unnecessary spending of money was big risk for me. That we should not do that.
Spending money.
Right? Unnecessary spending money was big risk. Second was, don't lose your money. Don't lose your capital. That was the second objective, right? When you start saving, you said, I don't want to lose my, and many people think that way. Risk is losing the capital. So that's the second level. I think third level came up to me saying that I should not be looking at capital. If I can make risk-free return of 6-7% in bank fixed deposit, if my returns in the funds are lower than that, that's a risk for me, right? Because I'm not able to beat inflation, I'm not able to beat a fixed deposit return. So the first was not losing money, first was not spending right?
Money.
Second was not losing capital. Then third came up that at least I should make a minimum return of 6-7%, but because that's what the bank gives. Now when I think about risk, I think in my mind, risk is that how variable is the outcome as compared to what you thought. So if a fund can give a return of 12%, but it can vary from 4 to 18, that's significantly more risk than a fund which can give you 12% return with 11 to 13 as the outlier. So I think how variable the returns can be. I think to me now, that is a bit, for example, if you look at commodity companies or commodity prices, they can move, swing from one extent to another. And therefore, they quote at a very low PE because they are risky companies, not because the companies are doing anything wrong. Commodities are very difficult to kind of forecast. So in my mind, so somebody says, oh, this company is available at a PE of 10. In my mind, maybe the industry they are in is very volatile, and therefore that risk is high, and therefore you get a low PE.
Okay.
Yeah.
No, because my your understanding, because by now you have the understanding of what is permanent loss, what is illiquidity, or reputational risk,
Right.
or breaking trust.
Yeah.
And you have to strike a balance all the time.
Right. So again, I think if
some of the things now are eliminated. Reputational risk and
I think if you do what you say and say what you do, I think 99% risk are taken care of.
Okay.
Because if you say that you are taking X amount of risk and people hear you, and if something goes wrong, they know that this is what you said, and this is what you do. So to say what you do and do what you say, I think eliminates significant amount of risk.
Do you have a decision rule when you actually, you will be evaluating options, you'll be getting proposals and fixed income, and it'll all have some risk, less risk, or one of these risks, not being able to pay, liquidity or mismatch, or sometimes, somebody looks very credible but turns out to be not so worthy of that credibility. So do you have any simple decision rule which people can benefit from, that if you come across this, never put your money?
So the rules are different for fixed income and equity. In fixed income, what we follow is something called C cube, right? Which means that we look at the character of the company or character of the promoter, multiply it by the cash flow the company generates, and multiply it by collateral. Now this has been evolved over the last 30 years. Earlier, in our mind, it was character plus cash flow and plus collateral. Now somebody can say the big difference, plus and multiplication may not be too different. But if you think mathematically, if they are plus, which means that if one is minus 2, other is plus 2, they will even out. When you multiply, if any one of them is 0, then the answer will be 0. So the new learning is that if you're not comfortable with the character, or if it's close to 0,
don't go any further.
Don't go further by cash flow or the collateral. If the character is good, look at the cash flow and saying, will the cash flow be good enough to pay us back on time? And if that is also good, then you say, by any chance, if that cash flow at that one time, something happens to the company and they're not able to pay, what's the backup collateral you have? I think if you do a good multiplication of this, I think very less chance of going wrong.
Tell me an example of, the C cube formula. I'm quite liking it. Interesting, where the other two, the subsequent two C were there, but the first one wasn't there.
So imagine a theoretical example.
Give me a real example.
I can't.
Everything looks nice, but
I can't put it on record the name of the company. No, they're slightly more sensitive, but I give you a record of something like. So if I am a promoter of a company, I come to you and say, Dhiren, I have 1,000 crores of shares with me as listed shares, and therefore my net worth is very high, right? My cash flow is 0 because I only get dividend from those shares, right? My cash flow is 0, but I have the net worth, all the net worth I have. Will you lend to me? Somebody can say, all these guys worth 1,000 crores, I can easily lend 10, 20 crores, but the cash flows are 0. Now imagine if you lend to that holding company. When the maturity comes, the company doesn't have a cash flow to pay you back, right? But it has an asset. By any chance, if the company is not able to refinance the debt at that point of time, COVID has hit, and refinancing becomes difficult, then you are stuck.
Or you have to sell the assets.
But it's easy to say sell the asset, but at that point of time, the asset prices would have come down because COVID has hit you.
But you have, against 1,000 crore, you have lent 20 crore.
Right, so 20 was an exaggeration. I'm saying if you lend 200 crores, and the 1,000 has become 400 or 600 or whatever. If you want to sell something, the news spreads out and the price goes down further. There's a lower circuit and all that. So in bad time, or not bad time, difficult time, if you have all these three, it helps. If in the good time, you can say that the company will get it refinanced for sure. I think all that learning we have put in this new fund when we launched, we said that we'll only invest in companies which has cash flow to pay us back. Now, cash flow can go up and down because markets are volatile, but at least the basic assumption is that you should have the cash flows to pay us back.
We will not invest in a holding company. Real money coming into the business.
Absolutely.
Right? So not even collateral doesn't help.
So collateral is by any chance the cash flows are not good enough, you have a collateral as a backup. But collateral can't be your first line of defense. First line of defense has to be the character. second line of defense.
How do you define character? Because there could be a company which you think is bad character and poor character, and but how do you actually mathematically define it?
So you're asking me engineering question on a creative process.
Yeah.
This is a difficult for the engineering student to, because we want as engineers.
Because if company has a cash flow, it has a factory, it produces some metal, it produces some oil, doing some validation, taking some raw material, changing.
Unfortunately, there is no black and white answer for it. It's something grey.
Because the other two are pretty mathematical.
Yeah.
I can look at 3-year financials and arrive at it.
So as they say, the character of the person is seen in the dark. When the lights are off, you know the character of the person. So when things are good, you know this person behaves like this. By any chance, if the times are not good, you have to take a judgment call. How will this person behave when the things are not? There's some industrial houses in India when even at the darkest time, they will stand by what they say and
honoring their promises.
Honoring their promises. Somebody can say that things are bad, and suddenly you can say, and I've seen this personally because I went through some challenging times, including people. When they behave with you when the things are good and the way they behave when things are challenging, that shows the true character. So you are trying to judge that character of that person, saying, by any chance, all my hypothesis is looking good. If they don't work out the way they work out, I thought, how will this person behave? Or how will this company behave when things are bad or things are challenging? I think that is the character you're trying to judge.
That is the ultimate test. But that requires, taking a bet. It requires, a judgment. It's a judgment call.
Yeah, and judgment can only come, as they say, good judgment comes from bad experiences.
Okay.
Right? When you have bad experience, then you know that how can this happen. So if you spend 30, 35 years, you've seen various cycles, I think that comes a bit natural. If someone who is the most genius student passing from IIT Kanpur computer science, may be very good at numbers, but may not be able to appreciate that, that character part. So I think it comes purely from, experience over a period of time.
So now I'm getting on to, leadership and culture of your job where you have spent nearly 2 decades at one place and led fixed income, and that shapes how you lead people. What kept you at Franklin for this long? Culture, learning, autonomy, or responsibility?
I think the character of the fund, character of the company.
What is distinct about it?
I think so. I worked in a couple of companies before joining Templeton, and obviously many of them were good companies. But I think when I in Templeton, I think.
How did you start?
In Templeton?
Yeah.
So I don't know how I got hired from ING. It was a small company, but I got hired. And I'm very grateful the two gentlemen, Stephen Doerr and Rajiv Vij. Those are two people who interviewed me.
Rajiv Vij. Okay.
Rajiv is a very smart guy. Then he became a life coach. He's based in Singapore and all that stuff. I think the character of the company, I like the character of the company in my sense is doing what is good for the client. And then I'm telling you such an easy thing to say.
Yeah.
But when stakes are not on your side, when there's money involved, when there's your short-term penalties involved, still you go and do what is good for the client. I think Franklin Templeton, I can tell you, I worked with some 7-8 companies till now. It will stand apart in all parameters saying, FT will do what is good for the client. Your call may go right or wrong. But when you take a call, you always keep customer in mind. That was the first positive. And second positive, I think, is thinking long-term. Don't think short-term, think long-term, because ultimately, if you keep doing the right thing for the customer, things will happen.
So what did this allow you to become?
So this allowed you to not compromise on values. So if you want to promote...
They are non-negotiable.
Non-negotiable. If you want to promote a fund, don't overpromise. Do what is right for the company, for the fund. Even the short-term hiccups, you go and say, this is what has happened. If money goes out, money goes out. But if you keep doing it consistently for a long period of time, I think the fund will do well. And secondly, as I said, that if things go bad, the company stands behind you. Unless if you're not done a personal mistake, or if the intentions were good and you did right for the client, and if by any chance the calls go here and there, the company stands behind. I think these two qualities, every employee, what they look for, that I should get the freedom to do what is right. If by any chance my calls go wrong, does the company kind of support me? I think.
So how do they differentiate between a judgment call which goes wrong and a mistake?
So
it's a very, very delicate thing.
Yeah, so FT has spent...
because, they say that they are very tolerant of stupidity.
Yeah. So
how do you differentiate this?
Correct, yeah. So FT has spent 77 years in the asset management industry. This company started way back in 1947 in US. You can imagine, Dhiren, me and you have seen 30 years. If somebody has spent 77 years in 60 countries...
You can't experience more than we are actually been alive.
Yeah. So I think that DNA, the company knows that short term, what can happen...
How it gets institutionalized in the business?
I think it's the culture the company has. For example, if you recall that Franklin Templeton bought Kothari Pioneer way back in late 1990s. Can you imagine? We still have the Chennai office where the fund management team works. Right? That's the way Franklin Templeton works. I think they stay behind the teams and they stay behind what is good. So I think
Retaining attracting
talent.
retaining people.
I don't know whether you know many of this first of India today. SIP is the biggest thing in India. Guess who started SIP in India?
Yeah,
Franklin
Franklin.
Templeton.
Yeah.
Who started all trail model in India? Franklin Templeton. Who launched the first floating rate fund? Franklin Templeton. Who started first US fund? It was Franklin Templeton. So I think we have many of this first in the country. And I think in the long run, if you keep doing things what's good for the customer, there's no way that you can't do well in the long run.
Being a CIO is a unique burden. You know, you have too many pulls, pressures, demands, you know, and you have gone through the hardest of time. Hardest part as a fixed income CIO, right, consistent, accountable.
I think consistent. I think it's both applicable for fixed income and equity. The world is moving so fast. There's so many moving parts that to be consistent in this difficult, volatile environment, I think it's a very Herculean task. So to be consistent for a long period of time, I think you should have something in you, because the time will come when your hypothesis will be void because something has changed. But if you stay put as a consistent performer for a long period of time, I think that is the most difficult part. And the second difficult part is to take the stress when things are not going the way you intend to. And I think, again, it's very difficult to explain, but you're on the top and things are not good. So I keep jokingly saying all these fund managers who keep CIOs who come on the TV and talk, you don't know what they go through when things are not going the way they thought they should.
But tell me, you know, what is that people romanticize about that? Oh, this should happen, or that should, you know, whether it be consistency or not going wrong, or you know, you just have to go wrong once.
Yeah.
That a lot of your good work will get completely, you know, wiped out. What do people romanticize about, but they don't understand at all that how it really works?
I think it's applicable in all the field. For example, cricketers. Right? If you hit 2 centuries, you are at the top of the world. If by chance
your case, what is that?
Yeah.
What is that they don't understand?
They don't understand that very difficult to be consistent. The expectations are that all point. If you're a good fund manager, you should be able to catch the equity cycle, a fixed income cycle, a gold cycle, and a silver cycle. If you're not, then how are you CIO if you're not able to catch these cycles? But they don't understand that, and that's true for every field. I think an actor can have a good film and a flop film. A cricketer can hit a century and then be duck. So the expectations from the small investors are so high from the CIO or from the fund management team that they'll be consistently good at all points of time. I think, but slowly, I think value research or all these medias, slowly, I think letting people know that it's a cycle. If you stay put for a long period of time, it works in your way, do SIPs and all that. Definitely it's improved a lot. But I think for the fund management team, I think more than the external pressure is maybe sometimes an internal pressure. The internal expectations from yourself is so high that if your call goes wrong or if you're not at the top of the chart, the internal pressure sometimes can, you know, kind of, how can I go wrong? You know, I am supposed to be good.
Now let's talk about disagreements. You know, the healthiest investment teams fight very hard, you know, internally. Of course, they don't make it public. How do you create safe disagreement with the CIO in the room?
I think the first...
Have you ever been loud?
No, because once you are, then the team will not speak. So what is the idea? Idea is that there's so much of happening in the world. One person definitely cannot manage all this. You need a good team to do it. A good team is what? A good team who can think independently, and guess what? Can also come and give you views which are very different than yours. If you are a boss who keeps vetoing everything, over a period of time, team will say, this guy vetoes everything, so why should I give my view if I'm on the opposite view? If I'm penalized often for not agreeing with the boss, why should I give a view? So there are many teams where everything is determined by one person. Everyone comes and says what the one person wants to hear.
That is how typically happens. No? You have such a certain framework that where does disagreement happen?
So the disagreement has to happen
because everything gets filtered. This is, you know, you have this 3C thing which you are saying.
Right. So
this itself will eliminate a very curated universe of things to evaluate.
Right. But for the first part, for example, the character. So we had a team when the mutual fund team, we had 4-5% in the credit team. I had a rule. Among this 5, if anyone comes and says, we have done all the research, but I don't think we should do it. Even if I have the strongest view that I should do, I'll say, okay, let's not do it. Because I know that not doing that one trade is not going to make a big difference. But if I give that, if I don't agree on that person's view, the person will say, no, nobody hears me. Why should I give a view so many times? So we had this veto thing that any 5 of us strongly believe that we should not do the deal for whatever reason. As you said, maybe the numbers are all stacking up, but somebody says, somehow I don't like this. We should not do. I think once you do that, I think the team has that team gets comfort that I am heard, and therefore the team will keep coming and telling you if they don't agree with you.
Hiring decides culture.
Yep.
What do you hire for?
It's a very difficult one because
Temperament, honesty, curiosity, or
I think honesty and integrity has to be all
of
the
course,
time.
that's
there,
given.
Right? But
Curiosity and aggression or firepower.
may not be always. I'll tell you how. As I said, there are three main. Please bear with me on a bit on my spirituality, kind of views. You have a sattvic person, a rajasic person, tamasic person. In sales, you need a more rajasic person who is a go-getter, who wants to do things and who is fast and all that. So we have our head of sales, Swati. You should meet her once. She's the one who says, I want to do it now. I want to do it better, and so on and so forth. On the research side or risk side, you don't need a rajasic person. You don't need a go-getter. You need someone who can think normally, who can take the time, who is not in a kind of too much of a hurry. So depending on the job, I think you can't get a go-getter in all the areas of your function. It will be disaster. On the risk, you need some other characteristic. On sales, you need other characteristic. CIO need other characteristic. So I think you have to mix and match depending on what the job demands. But at the same point of time, integrity, honesty, hard work, passion, I think these are non-negotiable. Right? They have to be there if you need to be successful.
That can only be demonstrated later. No, you can only subsequently vet for it. Those things you don't.
So then I can tell you.
How do you smell it at the point of hiring?
I think a few things.
Hiring is a conversation and a piece of paper.
Yeah. So a few things can only come with experience and age. So when we meet a company, for example, it's like making friends. If you connect with someone for half an hour, 1 hour, somehow you feel that this relationship will not go too far. Maybe you're wrong. Right?
It's worth meeting him again, or I enjoyed meeting him, or something.
Yeah. So you do it once, you do it twice, you do it twice, 3 times. If you meet, you can get to know whether this person is a team person, whether this person will gel with the entire team. And if you don't like that basic characteristic of the person may be the most genius, the most go-getter. It will not fit in the team. I think it comes significantly more from experience. But having said that, you can make mistakes. At that point of time, you're better off making a mistake on commission than a mistake on omission. Means that you don't want to hire a wrong person. You may let go a good person. That's okay. Don't hire a weak person or bad person.
In the investment team, are you narrowing it to the investment team or across?
Of course.
Okay.
Including sales and maybe compliance.
What is one red flag which will actually prompt you that not hiring?
I think integrity issues. Because once you have an integrity issue, then you can't take anything on face value, right? Then everything is off.
Now I want to go to 2020, not to relive the headlines, they were way too scary, and it's a very depressing context or time to recall not only the fund's life, but also the way our world changed for a period. But to extract lessons about decision making when the ground moves, ground virtually moves from our feet. So, when was the first moment you realized it was difficult kind of crisis? We had seen crisis in the previous 20 years, but this was a completely unusual one.
Yeah, I think a couple of points which give me indication much ahead of the time. Fixed income is an OTC market, which means that you have to speak over the phone to do a deal. Not on the GSEC side, on the corporate bond side. You have to buy or sell, you have to call up a broker. When you do a OTC, when you are speaking to someone, it's very easy for you to make out this is not working out. Bids are not coming up, they're getting scared. But you can't show your full...
it starts smelling bad.
It's smelling bad, right?
Okay.
But the proof came to me, I don't remember the exact date, it was I think in first week of April or something. GSEC markets, when they opened at 9 o'clock. For first half an hour, there's not a single trade on the GSEC platform. Then it's like saying 9:15 the equity market opens. There are no trades on the equity, no buy order, no sell order for 15-20 minutes. Then you know that something is drastically wrong. So I think when the GSEC there were no trades for half an hour, I knew that it was not looking good.
The world went to sleep.
Yeah, both the fear and typically when fear comes, the prices come down. Greed comes, the price goes up. There was no greed and no fear. It was like blank. I think that's the time I realized this is not looking good. So first thing I was taught in Frank and Templeton was when things are not looking good, first thing is to come and tell the team, your bosses, your seniors that I am sensing that something may not be right. So I think that's the first time I got a feeling that it will go bad.
In those moments, leadership is basically a sequence of decisions. The single hardest decision, how you choose under uncertainty. I'm not talking about the big thing.
Right.
How you choose that uncertainty. It will be happening even now sometimes.
I think if you know that you're taking a decision in the best interest of investors, and the company is standing behind you, and it's a company's decision to say that this looks good, let's go about it. I think maybe the hardest decision in life, but with that support, you can say with...
What were the options on the table? What did you rule out quickly?
I think the option on the table, the option was to take an easy way out and keep selling at whatever price it comes in. You are an intermediary. You can keep selling. If the equity markets are down and somebody wants to redeem, you can sell and fund it even if the markets are down, right?
And so collapsing.
Yeah.
And fixed income market collapses faster.
Somebody can say, you're an intermediary. If somebody wants to redeem, you can sell at a lower price, you can sell. But obviously, that's, as I said, it's a cascading, it can have a cascading impact. The second thing was to say, take some shortcut measures and make sure that somehow you take care of a couple of days, but very well you know that long term it may not sustain, because COVID was such a thing that nobody knew how long it will sustain.
What's ahead?
Or you take a difficult call, saying that good term, long term it's good, let's take that call. It may be difficult that point of time, but I think you take that call, and conscience is very clear that you're doing it for what is right for the customer. And you're very confident that if you think you're done right for the customer, over a period of time, the market will appreciate it and you can come back. And this exactly happened with us, for example. We are launching this new fund, which is a credit risk fund, which we founded up in 2020. So that shows the character of the company. We thought that...
open-end structure?
It's a closed-end structure. That's a big learning.
This is the alternative investment. Okay. How did you keep your team steady during that period?
Oh, that was the most difficult part, I think. The good part was that I made sure all the stress which was coming to me, not an iota of that was going down to the team. Because we had a good amount of money to manage on our AAA funds and GSEC funds and all that. And everyone was very anxious. In my mind, I knew that I made all the benefit when things are good. Now I should be the last point or the first point. Beyond that, the stress should not go down. So my team, my credit team, my fund managers, they were all behaving absolutely normal, as if it's a normal day for them. And that was difficult for me because the buck stopped at me, right? I didn't have much of... I could sense that obviously we're not going through good times, but I had to put a brave face and say, come on guys, it will be okay. You do keep doing your job. I think that was difficult.
You were lying to your team.
Maybe lying or maybe giving them false hopes, but heart to heart, I knew.
It was important to inspire them.
And heart to heart, I knew that we didn't do anything wrong personally, and therefore we had taken a right call for the investors.
Yeah, it was the environment which was extremely hostile.
So if you're totally convinced on that, I think, but if you have doubt in your mind, then obviously it will show up. So the good part was the fund management team worked as if absolutely normal. They kept doing what is good for the investors. And over a period of time, I'm sure we came out.
So crisis also test, communication and trust. So what crisis taught about your communication and trust to team and investors in the, before the whole thing blew up?
Yeah, I think as I say, do what you say and say what you do. I think if you keep doing that, then I think significant portion of your problem goes out.
That is the,
you should not try
that is
to
the mantra,
sell.
that is the preamble.
Absolutely. Okay. You say as it is. If people are interested, they will come in. If they are not interested, if they think it's beyond the risk appetite, they will not come. But your job is to clearly state what you are doing, show what you are doing, and then do what you say.
What did you learn about what investors hear and what they want to hear? Was there any learning for you?
So then as I said, you show a God statue to someone. Somebody will see God in that, and somebody will see a stone in that. It means that whatever you want to see, you see that. So when you speak, whatever people want to hear, they hear that. So if you speak about reward and risk, this is the reward can come, this is the risk can come. Anyone who is very concerned about risk will only hear the risk part. Somebody who is like, I am more concerned about reward will only hear the reward part. I think it's human tendency. You tend to hear or see what you want to hear and see.
Now let's just convert this into a kind of portable wisdom for the people hearing us. 3 lessons for young fund managers. What you would tell a younger self?
It will be a very different answer for what you would have thought. I would strongly recommend that from an early age, do something on the spiritual side, because that will be essential for you.
But that is, a younger guy will actually try to impress before, he lands into trouble and actually gets into spirituality.
So that is the mistake which they do. I thought if somebody would have given me this spirituality gyan, maybe when I was a kid or in the school, and very basic stuff like, what Bhagavad Gita says, right, that you keep doing your work, don't worry about the result.
On work.
I think the anxiety level can significantly come down. That's the first. Second, you have to have that mental, if you need to be in this business, you need to be a senior person, you need to have that mental stress-taking capacity, and it's not easy at all.
How to develop resilience of this kind?
I think you would know that when things are good, things may go negative, and when things are negative, you should have a strong belief that I may go wrong sometime, my calls may go wrong. If you believe that, you will handle
Okay,
it better.
that is the personality part of
Yeah.
it. But tell me more tangible things. One lesson on liquidity, one lesson on portfolio construction, one lesson about communication.
I think if you're a lender, if you are into fixed
course, you
income,
are
right? I think
You are a lender and you are actually taking investors' money. So,
correct.
you are
No, I'm saying as an equity fund manager, as a debt fund manager, two
As a
different
debt-
things.
debt manager.
Debt fund manager, I think two things on liquidity and credit risk. In my mind, liquidity risk means that the company has the ability to pay, the intention to pay, but there are short-term cash mismatches and therefore you're not able to pay. And that's the liquidity risk. It means ultimately you get your money
That
back.
is your investable universe.
From the investable universe, you know that this company has the ability, will pay me back, but today they have a cash flow problem and that's a liquidity problem. That's easy to handle. Obviously, you will get impacted on your NAV and so on and so forth, but ultimately you will be able to get your money back. Credit risk is something which says that the intention is there, but the ability is not there because the asset value has gone below the liability value, which means you will have to take a haircut when you take a position on this. So liquidity risk is significantly manageable. Over a period of time, you will get your money back. Credit risk, obviously, you will lose some part of your principal.
Now I have come to the next chapter and end of this conversation, but next chapter of you have now moved into building alternatives in India. And that's the new chapter of your career.
Yep.
After 2020, what drew you to this new responsibility? Or was this a matter of choice or it is a forced upon you? What are you trying to build?
Yeah, so FT, for example, is a mutual fund company for the last 77 years. Many people don't know that over the last 10-15 years, a significant portion of FT's AUM is on alternate. So today we are the 10th largest alternate company in US. We manage close to $275 billion in alternate fund. And it was very clear that India over a period of time will see a focus moving towards the alternate side. Okay. And therefore, I said the companies, because of the pedigree and the history and the track record, knows that this is going to be a big segment. I keep jokingly saying that, way back in 1993 or 94 when I joined this industry, FD was traditional and mutual fund was alternate. It was so complicated and the NAV will go up and down, mark to market and all that. Today, mutual fund has become traditional and you're looking at something which is different than mutual fund as alternate. I think over the next 25-30 years, what happened to mutual fund industry for last 30 years, my view is that something similar will happen to alternate in the next 25 years.
Cooking up for alternate or future.
Because an economy like India, which is a $4.5 trillion economy going at 10% nominal GDP growth, requires capital at different stages of capital that cannot be provided by a public pool of money, that can be provided by a private pool of money. And therefore, it's essential that you have alternate.
And alternate means, can you define alternative investment for the people listening to us? That it's a compromise on liquidity?
So,
what's the design?
A very simple way to understand, anything which is not public is private. That's one way to look at it. Second way to look at it, like private is essentially, obviously there are many ways to look at it, but one way to look at it is that investing in securities which are not listed in the exchanges, that makes it illiquid, and therefore you will have to compromise on liquidity for 5-7 years in the fund. So private companies, closed-ended funds, you should be able to take the illiquidity along with you, and you can customize the fund to the needs of the investor. If you need a high risk, high return, low risk, medium risk, what all combination you need a hybrid structure, you need a super senior, you need a sub structure, everything is possible in alternate, and therefore with a significant amount of flexibility, good for the economy and good for the investor.
What about the tax design, the tax efficiency of the mutual fund that we enjoy?
Yeah.
That whatever you do, the tax treatment depends on the way I for how long I hold it.
Yeah. So I think
does that continue here too?
No. So the taxation is similar now. Earlier it's not the case. Fixed income, the mutual fund had a significant tax benefit. I think that was one reason why alternate did not get developed, because mutual fund had a significant tax advantage. But now that tax advantage is kind of minimal. The only big difference being in mutual fund, you pay the tax only when you redeem, but in alternates, you pay tax even whatever you keep earning, you need to keep pay tax on that. The fund...
Is the individual paying or you are paying as a company?
So CAT 2, CAT 3 are two different taxation. CAT 2 the investor pays, we just deduct a 10% TDS. CAT 3 the fund pays, but the fund, for example, the equity fund,
the fund gives the credit to him. That tax credit is available to
investor. But the big difference is, in a CAT 3 equity fund, if you do a short-term capital gain, you need to pay tax immediately. In a mutual fund, The fund can do a
That
short-term
gets
trading,
deferred, yeah.
but it gets subsumed in the long term, and the investor only pays when the investor redeems. So there's some nuances. Otherwise, more or less, I think
More or
tax
less,
structure
it's about
is
the
the
same. We have come to an end, but before I close, here is a set of rapid-fire questions which I want to fire.
Okay, please go ahead.
A great investing career is built on
Consistency,
risk is
losing capital,
the most underrated skill in a CIO is
spirituality,
not being spiritual.
not being
Okay.
spiritual.
One mistake you won't repeat.
I think being selective where you work or which company you work with.
The best advice you received.
Stay truthful.
Stay truthful. A daily habit that keeps you grounded.
Spirituality.
Now you ask your question.
So Dhiren, you have been tracking the industry for the last 32 years. If I ask you, top of your mind, the best equity fund house in India,
There are quite a few of them.
you can't be hedging your bets.
I'm not hedging up my bets. Everybody goes through cycle.
Right,
So if I have to choose one, if I have to choose one fund,
right.
it will be very difficult because there will be a great value guy, there will be a great growth guy. And if I have to choose two, I will, I'm not hedging, but that is how individuals should actually build their portfolio.
What's your biggest learning in the last 32 years you've been tracking the mutual fund industry?
Don't get excited about equity market when it gets very exciting, and don't run away from when it gets so depressing to stick around.
And the $1 million question, where are we today in that situation?
I think we are somewhere in the exuberance even now.
Okay. And asset allocation, if you have 100 rupees to invest today and you are a fairly risk-taking investor, what portion of your money would you put in equity and fixed income and alternates?
I have a very different approach to asset allocation. I would say that anybody getting started, for first 5 years, he should do no asset allocation.
Okay.
He should invest 100% in equity.
Okay, he or
Because
she.
you are a young guy, he or she, because you are getting started. Asset allocation is to hedge against risk.
Okay.
Once you have something meaningful that you start allocating,
Right.
then you don't need the money for next 10 years,
Right.
have 25% into equity.
Right.
And once you want to have a peaceful life, you don't want to worry, you have enough money, then have 50% into equity, 50% into debt.
About your value research rankings, I'm sure you've been ranking for so many years. When you rank a fund 1 star, 2 star, I'm sure there's mutual funds call you up and say, I don't agree with your ranking. How do you kind of...
The way we have crafted the way we have designed the rating, it was created in 1993. It was created in 1993 and published in Business Today magazine every 3 months for the first 10 years. And it was created at a time when it was not needed because there were only closed-end funds. Ratings could not be used for choosing a fund. And we refined it thereafter. Then the open-end funds happened in mid-90s was the beginning with Kothari Pioneer and Prima Plus, Blue Chip and some other open-end funds. Because even Morgan Stanley remained a closed-end fund for a long time, where the rating cannot be used because it became a pointer to making an investment decision. What happened here was we devised a rule, the traditional, the academic definition of risk-adjusted performance. We have a methodology, it's a formula, and it's a relative formula.
Right.
How volatile you are
and
how much return you have given. If a fund travels from 10 to 20, one falls 50 times, one falls less often. The one which falls less often is more comforting. And it was based on the basic premise, not in terms of the academic. We devised the formula later. But the pain of losing money is far more than making money. And that is what is reflected in this formula. And that is what, so we have a lot of people who complain about the ratings.
Is it?
But it's an open system. You can do it yourself. In fact, everybody who complains, we share the spreadsheet of what is driving the rating.
Okay.
Sometimes early days, we had some new players. They used to think that they can buy the rating.
Is it? Okay. By the way, who are these funds? So who called you for buying the rating?
Once again, my professional, sobriety prohibits me from saying that. But no, but not because of that. It was not their intention to bribe me. They thought that the ratings are bought. In all other facets of life, you can go and get a certification, you can go and get an accreditation, you can go and buy a validation. So they thought that this is something, and it is not a system-driven month-end basis, and it follows a methodology, and that is documented. So it took time and there are people who dislike me when the rating slips. There are people who disagree with it when the rating slips. The simplicity of the rating system, that it's star, a good star, a good hotel on a 5-star scale. A good chocolate is also called a 5-star. So people think that it's a very intuitive way to absorb that it's a good fund. So it's a 5-star. But there's much more to it. I think the way I look at my rating is very different from the way my consumers actually absorb it. I think that my rating is very useful for weeding out the duds.
Okay.
And it narrows your universe as investing life becomes complicated. Start your selection with 5-star, 4-star and 3-star fund, and then figure out that what they are actually doing.
Okay.
And then there are mechanisms, there are data points. And that is why we have an overlay over and above the rating, where a set of analysts sit and look at these numbers. Is it sustainable? Who is running it? How do they think? And do they have the substance?
Fantastic. One last question. You are a private company. You are monopoly in the mutual fund research space. When do you go public, or are you taking private equity money?
I don't intend to go public till I need the money. And I won't take the private equity money till I need the money. I don't have a plan which is held up for money. This is a business which requires a lot of bandwidth, a lot of capability, and it is. And also, I have been little less imaginative in my initial years. That became a habit that has held me back in terms of being a very, growing rapidly and scaling up substantially.
Okay. All the best to you,
And
Dhiren.
I don't intend to get back into any unrelated area. I've been a very early believer of, Peter Waterman, in search of excellence, stick to your knitting.
Absolutely.
And not getting distracted from what we do very well. And doing it with passion, doing it with belief, doing it with a spirit of helping large numbers. So we are a very tiny business, but we are a very impactful business.
So how many subscribers or how many sales would you have in a month's time?
If you look at my subscriber base, I think we will be among the largest print published monthly magazine in the country.
Wow.
And real customers paying for it. But more importantly, it's not about that. It's a multiplier effect. My magazine people don't throw, they share, they keep it. But besides that, the digital footprint that we have, that has virtually democratized our opinion and information to a much larger base. So maybe we connect with nearly about 1.5 crore people every month.
Fantastic. I can suggest you one related activity which you can do. You said you don't want to do unrelated activity. I think you should open a business news channel.
No, I think it is too much of noise. We are so much about giving people clarity. Clarity, limited, and money is very dear to people. I don't want to reduce it to entertainment.
Fantastic. Thank you very much, Dhiren, and all the very best to you and Value Research.
Thank you very much for your time. And this was all about process, temperament, and the reality of lending through uncertainty, and the stuff that doesn't show in results often. Thank you very much.
Thank you very much, Dhiren. Thank you.